Let's understand the tax benefits that one gets as per ULIPs and NPS.
Good evening, Kavita. So, when it comes to ULIPs, one has to consider the tax benefits at two stages. One is at the time of investment, and the second is when the amount comes back at the time of maturity. At the time of investments, you get a deduction up to 1,50,000 under Section 80C of the Income Tax Act. So, this is ULIP is another of the measures along with various other options which you get under Section 80C. However, a couple of years ago in the union budget, the rules were changed to say that if from 1st February 2021, if the total premiums that you pay on ULIPs exceeds 2.5 lakh a year, then the amount which comes back on maturity would be taxable. In normal circumstances, under Section 10(10)(d), the amount which comes on the maturity of the ULIP policy would be tax-free. So, if now you are taking a new policy and the premiums of either one, or if you have more than one policy and the premiums of these together exceed 2.5 lakh, then the amount will become taxable on maturity. So these are the provisions related to ULIPs on the tax front. Now, if we go to the National Pension System, which is the NPS, there also we need to consider the tax benefits at the time of investment and at the time of maturity. So at the time of investments, rupees 1.5 lakh you can get as a reduction under Section 80CCD1. And this is clubbed along with the Section 80C benefit, so that the 1.5 lakh is the basic amount to which you can go to. But the benefit of the NPS is that under Section 80CCD1B, you get an additional 50,000 of deduction also. So if you have the deduction is available only for investments in tier 1 account. So there is no benefit for investing in the tier 2 account, which is like savings account wherein you can invest and take out money anytime from the NPS. The second point is that when you are looking at the NPS and the tax benefit from it, you have to be choosing the old tax regime, because under the new tax regime, this deduction will not be available. Now we come to the second part, which is the time of maturity. In this case, we consider the time of retirement when the amount accumulated in the NPS can be withdrawn by the individual. At that point of time, 60% of the amount can be withdrawn as a lump sum, and this lump sum is tax free. The remaining 40%, which is remaining, that at the point of maturity is tax free, but you have to compulsorily convert it into an annuity. And the annuity, which is nothing but a pension like figure which comes in every month, that would be taxable from this 40%, which is compulsorily converted into the annuity. So at the time of maturity, 60% becomes tax-free, the remaining 40% is converted into an annuity, and the taxable impact only comes when you start receiving the annuity from that remaining 40%. So these are the tax benefits and implications of both these routes which have been considered today.